Hello students, welcome to chapter 10 part 1 of business studies, that is financial market. Now what is financial market? It is a market for creation and exchange of financial assets such as shares, debentures, bonds and government securities. So we can say that financial market is a network of institutions which provides short, medium and long-term funds. And financial market makes possible the transfer of money from the investor to entrepreneurial borrowers. Now they bring together the lenders of fund and borrowers of fund. So when we talk about allocation of funds, two alternatives through which allocation of fund can be done. One is through bank and other is through financial market. So household savers can deposit their surplus fund with the bank and bank can then lend these funds to business firms. So household savers can also invest their savings in financial market directly by purchasing the shares and debentures offered by the business firm. Now we can see that both bank and financial markets are competing financial intermediaries. So let's understand what are the functions of financial market. First is mobilizing of saving, which means you are channelizing them into the most productive purpose. So you're investing or saving money in such a channel which gives you productive result. So it offers the investors different investment avenues and help them to channelize their surplus fund in productive use. The second function of financial market is price discovery. Now, price of any product is determined by the forces of demand and supply. So, interaction between investors and business firms facilitates the price determination for the financial assets which is being traded in particular market. The third function is providing liquidity. So, it is the financial market which provides liquidity to financial assets, which means converting them into cash by selling them in the market very easily. And it also reduces the cost of transaction because it provides a common platform wherein both the buyers and sellers they meet together, they do the transaction, that is trading their security without much of cost and time. So to sum up, we can say that the function of financial market are mobilizing savings, price discovery, providing liquidity, and reducing the cost of transactions. Now let's see how is the classification of financial market. Financial market can be divided into money market and capital market, and capital market can be further subdivided into primary and secondary market, which has both debt and equity. So first let's understand money market and then we will move on to capital market. So what is money market? Money market is the market for short-term funds. Now short-term funds are meant for period of up to 1 year, and money market is usually located at particular place. So it is the term used to describe all the organizations and institutions that deal in short-term debt instruments. It is the money market which makes possible the raising of short-term funds so that that fund can be utilized for day-to-day working of the firm or organization. When we talk about the features of money market, the first is participants, that is RBI, commercial bank, non-banking financial institution, state government and large corporate houses and mutual funds are participants. And short-term debt are the instruments which are traded in money market. Now, in this kind of money market, huge sum of money is being transacted, and the duration is from 1 day to 1 year, and the liquidity is very, very high because it can be easily converted into cash. There is a safety, or you can say that short-term duration ensures greater safety, and no physical location activities conducted over the telephone or internet. When we talk about the returns, they are comparatively less, and instruments traded over here are unsecured. So let's talk about money market instruments. Treasury bills, commercial paper, call money, COD, that is certificate of deposit, and commercial bill are the money market instruments. Let's understand one by one. Treasury bills, or we can also call as T bills or zero coupon bonds, these are issued by RBI on behalf of central government, and the maturity is less than 1 year, and it is an instrument for short-term borrowing by government of India. They are issued in the form of promissory notes. We can see the example over here, wherein they are freely transferable as it comes under the Negotiable Instrument Act. And they are issued at a price which is lower than the face value and repaid at par. And the difference between the issue price and redemption value is called as discount. So it is available for minimum amount of 25,000 in the multiples thereof. Now, after treasury bill, the another money market instrument is commercial paper. This is again unsecured promissory note, which is issued 3, 2, 1. So, as I said, that it is an unsecured promissory note which is issued to public with a fixed maturity period ranging from 15 days to 1 year. Now, when we talk about the commercial paper, this serves as an important source of working capital and for bridging the financing for raising long-term funds from the capital market. Now, these commercial banks and mutual funds contribute towards this kind of instruments. For example, to meet flotation cost, brokerage, advertising, printing, and share applications. The third money market instrument is call money. And in this case, day-to-day surplus funds of the bank and other financial institutions are dealt with. We can say that the duration of call money is from 1 day to 15 days and is repayable on demand either by lender or the buyer. And interest paid on call money is called as a call rate. The fourth instrument or the fourth money market instrument is CD or COD, that is certificate of deposit. It is an unsecured, negotiable, short-term instrument in the bearer form, which is issued by the commercial bank and financial institution to the individuals, corporations, and companies. The another money market instrument is commercial bill, or we can call it as a trade bill. Now, this is a bill of exchange used to finance working capital requirement of a business. And it is a short period, negotiable, and self-liquidating instrument used to finance credit sales. This is an example of commercial bill. On credit sales, the seller or the drawer draws the bill and the buyer, that is drawee, accepts it and by putting his signature on it. On acceptance, the bill becomes a marketable instrument which is called as a trade bill. Now, this bill can be discounted with a bank if the seller requires fund before maturity. So, when a trade bill is accepted by a commercial bank, it is known as a commercial bill. So, we saw that money market instruments are treasury bill, commercial paper, call money, COD, and commercial bill. Thank you.